In today's video, we are explaining different types of funds. We are explaining what is an index fund, what is a mutual fund, what is a hedge fund, and also what are it, and which fund should you invest in. First and foremost, let's define what is a fund. Imagine yourself and your friends. You want to buy beer and wings and other snacks. You have only $10. But out of $10, you want to buy beer, you want to buy wings, and other snacks. You are clubbing with your group of friends, with 4 friends. If you are only going to use your $10, this won't be enough to buy wings. Now you and your group of 4 friends, you put together $10 each. Now you can buy beers, wings, snacks, and this will be enough. That's the concept of a fund. A fund is a pool of money put together by different investors as to achieve diversification in the market and avoid risks. Assuming that you're investing on your own, you have only $20,000 to invest, you might invest in very few things. If there is a downturn in the market, you end up not doing very well in the sector which you have invested in. An investment fund is a pool of capital collected from numerous investors to collectively purchase securities like stocks, bonds, real estate, etc., etc., etc. These are managed by professionals and allow investors to diversify. Let's now start with an index fund. What is an index fund? An index fund does not try to pick winning stocks, just follows an index, tries to mimic performance of specific market benchmark. It's a passive investment. It's a portfolio of stocks and bonds offering a broader diversification of market with low fees. Let's look at some of the index. S&P Standard & Poor is an index. NASDAQ is an index of 100 tech companies in the US. Dow Jones is an index of industrial averages of 30 large companies across the industries. There's also an index of small companies. There's also an index of international markets. There's also an index of TSX, the Canadian stock market. There is also an index of emerging markets like the BRIC. There is an index of international markets. An index fund is passively managed. It just follows the index. So they throw your money there and they don't look at it every day, how it is performing. It just follows an index. It just follows how the small companies are doing or how Dow Jones has done today. At the end of the day, you hear that the stocks were down today, or Dow Jones, Standard & Poor at these points, or NASDAQ finished the day down by so much points. So that's what an index fund just follows how that index is doing, how Standard & Poor is doing, how NASDAQ, 100 biggest stock companies are doing, how Dow Jones, 30 large industrial established companies across the industry are doing, how the small companies are doing, how international markets are doing, how emerging markets are doing. Most of the index fund charge a very low fee called expense ratio, 2% to 0%. You get to keep the profits. Unlike stocks, you can't buy an index fund any time of the day. Stocks I can get in at the market open, 9:30, 10:30 I can get out, or even 10 o'clock. 30 minutes in I can get out. Just as I realize that the stock is not going my way, I can get out as quick as possible to cut my losses. But an index fund, unfortunately, you can't buy it any time of the day and get out any time of the day. You can only buy it at the close of the market. They close at 4 p.m. You can place your order to purchase an index fund any time of the day with whoever broker or whatever institution you are buying through. Then your order will be only put through at the end when the markets close. How are index funds priced? An index fund is priced by total assets minus expenses over number of shares. The price of the index is called net asset value. NAV. It's net asset value, which is equal total number of assets minus expenses over number of shares. Why are index funds popular? I've heard even people like Warren Buffett recommending them. And people would say, if I just put my money in an index fund, or one time I heard somebody say, if I win the lottery, I'll just throw my money in the index fund and live on the profits. Why are index funds popular? Low cost, low effort. You set it and forget it. You don't actively manage them every day. You don't monitor them. Even people who are responsible for them, they don't monitor them. Yourself, you don't go to bed worrying about index fund. Market can go up and down. You are not worried about your index fund. Let's look at the markets. They go up and down like this, right? They go up and down. But it's like we started at 20,000 points at the beginning of the year. They go up another 5,000 points, they come down, they go up another 3,000 points. At the end of the year, they end up at 23,000. If you're in an index fund, you have made profit because you started here at 20,000 points. But at the end of the year, you have ended up with, say, the international markets index fund have ended up with 20,000 points. You are not worried about day-to-day market gyration, the market swings of every day. They shouldn't bother you at all. You are focused at how does your index fund perform by the end of the year. So low cost, low effort, set it and forget it, and usually outperforms the market. What is a mutual fund? A mutual fund is just like an index. It's a pool of money from investors put together to purchase stocks, bonds, real estate, and whatever investment vehicles they invest in, like the index fund. It's actively managed by professional managers. These professional managers, they actively pick stocks with the goal of outperforming the benchmark over time. They pick stocks which they think over time will go up, like Tesla stock, like Amazon stocks, like Microsoft stock. These are some of the stocks they could pick, individual stocks in the market with the goal of outperforming benchmark over time. The fees are a little bit higher. The fees is to 1.5%. I remember one time I invested in a mutual fund with a bank here. First put in 3,000 and every now and then I was putting in more money into it. But over 6 months I realized that my money was less than what I put in. And then I decided to withdraw and close that account. Sometimes they don't perform better. Depend with the manager. Some of these portfolio managers or money managers, they have very poor results. Yeah, like that money manager was a terrible money manager. And here we also have one of these banks, which I won't mention in this video. One of their money managers lost like 600 million beginning of last year. Reasons for buying mutual funds. There are a lot of mutual funds out there. Here in Canada, most of these major banks like CRBC, TD Bank, they offer different types of mutual funds. If you want to invest in a mutual fund, they'll give you a booklet with different types of funds. They will tell you what they invest in. I remember when I invested with one of the banks, one of the funds was investing in other banks, but I didn't pick up that one. Reasons to buy mutual fund. You believe in the specific fund because, as I said, that you study the fund, they will give you some literature to read on different type of funds, what they invest in. If you believe in what the fund is investing in or the manager's strategy, and they also tell you who is managing that fund and his track record. Obviously, like this one who lost 600 million, and if he goes and work for another bank, they won't tell you. They might tell you that he has done very well in the past. In Canada, there are also insurance companies and other small investment companies that offer mutual fund. Mutual fund, just like the index fund, they are priced at the closing of the market at 4 o'clock. Now, let's move to hedge fund. What is a hedge fund? Just like other funds we have talked, is also a pool of money. They do very aggressive and complex strategies to have high returns. High returns, high risk also equals huge losses. They take money from individuals with a high net worth and also who are earning big bucks. So they invest in bonds, in stocks, in real estate, and in derivatives. That's a risk area. A hedge fund uses leverage, can borrow money as to invest. They also use short selling. Short selling is you borrow stocks and sell them, and then you buy them back at a lower price at the end of the day, and then you put them back. They can short sell over a number of days. You are projecting that stock XYZ will go down by the end of the week because there's bad news coming from that company. You borrow 10 million stocks from your broker if you're an individual investor. You sell them. By the end of the week, bad news comes. That stock was $20. Now that stock is $15. You have just made 5 per stock times 10 million. That's short selling. They use very aggressive strategies to make money, and they have high returns, sometimes also equals huge losses. How are hedge funds managed? They are actively managed by fund managers. So how are the fees? The fees of a hedge fund, they use 2 and 20 model. 2 and 20 model. What do we mean by this? 2% fees and 20% of the profit. If they pull in all the money from the investors and the money comes to 10 billion, he takes home 2% of that, of 10 billion. You do the arithmetic. And if he's making profit, that's another 20% in his pocket. But of course, if he keeps on making losses, the fund will yank him out. You can't keep on losing people's money. Otherwise, you scare the potential investors or even other current investors withdraw their money. The last one, but not least, we are going to look at, this is called exchange traded funds, and it is an ETF. Unlike mutual fund and index fund, ETF you can buy it throughout the day and can buy it at any time of the day and sell it at any time of the day, just like stocks. You can buy it anytime and sell it anytime. The people who put the ETF together, they would have invested that money in various sectors of the market. And if one sector is not doing well, and always another sector will do well. What are the advantages of ETF? They are low fees, and the expense ratio is very low. It's 0.03% to 5%. That's the fees for the ETF. And they are also passively managed. They follow the index designed to track the performance of a particular sector. ETF can be bought and sold on a brokerage platform. I have 2 brokers. Here in Canada, unlike the United States, we still have brokers who charge brokerage fees. With one of them, there's no fees. In Canada, we have ETF that pay a dividend. I know an ETF that pays like 12% every quarter. So just like a dividend stock, you are not worried about the performance of that ETF. In closing, ETF and index fund are the best choice for an average Joe, for everyday person. They are low cost, easy to understand, and they offer diversification. Hedge fund are for the wealthy people. Mutual fund are a little bit complex to understand. You cannot guarantee their performance. We thank you for watching this video. Please smash the subscription, smash it, hit it hard, hit it again. Hit it again. Thank you.